Hello, everyone. Okay, today is July 30th, about 7:30 at night. The reason I'm doing this video is today silver and gold both were pushed down today. I just want to review what I think is one of the best strategies for trading and something that most people can make money doing, and that's selling put options. If you have never traded options, if you've never read up on options, it's probably voodoo, right? You've heard stories about it. You're probably afraid of it. And I actually would encourage you not to be afraid of it. In fact, the people who I've introduced options to, once they learn what I show them, they tell me that they'll never trade stocks the same way ever again, because there are many, many advantages to doing that. But I just want to review, I figure something I can do is, with the way the economy is going, is I'm not a professional trader. This is not my business. I do this for, I won't say enjoyment, but I do it to generate additional income. And so with that in mind, anytime you trade, you can lose a lot of money. So if you're not comfortable trading, then take this as entertainment value only. If you do enjoy trading, then maybe this will also be entertainment value for you, but maybe it will give you some ideas on what you should look at for trade ideas. When I sell puts, I like to sell them when the stock, first of all, you should only really sell puts on a company or a stock or an ETF or whatever it is that you really want to own. So it's something that is worth owning, worth holding. Because when you sell a put, you want to assume that there is a chance that you could get exercised, which means that you would take possession of the shares. And if you take possession of the shares, you may have to hold them. Maybe. All depends what you want to do with it. So you don't want to sell puts on a company that you think is a dog. All right. And when I sell puts, there's really two strategies. Number one, I'm just trying to collect the premium on it, or I want to take possession of shares at a discounted rate. So I'm going to go in and show some examples. And instead of me going through the whole diatribe on what an option is, there's plenty of videos out there. I'm just going to focus on what I think are some good trades as of today. Okay, so see, the price of silver was beaten down. It was as high as $26 a few days ago. There's a chance it could go lower. Okay, some people are talking $19, $20, $21. So it's at $23.43 as of right now. Now, First Majestic is symbol AG. This is a very, very volatile company or stock. Company is a very good company in my opinion. I've done research on it. They've been around a while. They've invested a lot of money into their company. They are a miner, primarily in Mexico. It's a Canadian company, but their mines are in Mexico. Their all-in sustaining cost for silver is approximately $10 to $12. Silver today is $23.44. So you can see that they are dropping approximately $10 to $11 for every ounce of silver that they mine down to the bottom line. So right now, this is the time to own miners. They were as high of a price as $14.50 a few days ago. They dropped below, as you'll see up here at the top, the low of $12.84. Now, I could buy those shares. The ending price was $12.97. So let's just say $13. You can buy those shares for $13, but I could actually buy those shares tomorrow, okay, for less than that by selling a put. And what you do is at a strike. That's not what I'm going to do. I'm going to go out and I'm going to choose August 21st. It's 3 weeks from tomorrow. If you chose a $13 strike price, okay, and I'm going to go out to September 18th, which is almost 2 months, I'm going to choose the $13 strike price. And then I will choose tomorrow. Here are the 3 dates. Now, you would choose sell to open. One contract is the right to, when you buy an option, you are controlling the right to either buy or sell shares. When you are selling, you basically are providing insurance to somebody else. So somebody else has these shares, and we're their protection. So in essence, whoever owns these shares, if the price drops below $13, I would own those shares. So if the price finishes at $12.97, I would take control of 100 shares of this stock. But as you'll see, tomorrow, let's say tomorrow stays exactly the same as right now. If I sold these for 25 cents, okay, then basically I would pay a price of $12.75, which is cheaper than that, okay? If I go 1 month out or 3 weeks out, you'll see 99 cents, $1. So in essence, my cost basis would be $12. And if I go 2 months out, my cost basis would be $11.55 because it's $13 minus $1.45. So this is an excellent way. If you've identified companies that you want to own, then you could do that. Now, the reason you want to sell a put is, number one, I'm convinced that this company, First Majestic, is going back to $14.50 or higher, right? If I have that belief, then why would I not want to try to own this company right now? Or why would I not want to collect this premium, this $1.45? So let's just say I do 10 contracts. I'm going to basically just put $1.50 or $1.45, we'll say. Why not? Okay, so I choose the mid price. So you'll see that the premium that I will potentially collect is $1,450 without ever taking possession of this stock. So the reason I'm selling these puts is I believe the price is going higher. And instead of me taking possession of the shares, I'm basically scalping this, okay, for lack of a better word. I'm collecting the premium on this. So if this stock is $13.01 or higher on the end of business on September 18th, then I will collect this $1,450 and move on. If the price of this stock is $13 or less, then I will take possession of these shares at $13. And then if I factor in the $1.45, then my cost basis would be 13 minus 145. So my cost basis would be $11.55. The potential negative is just like owning the shares. If the price of this stock drops, then I could potentially be underwater on this stock. So if this company stays at $12.97, then I would take possession at $13, but it would be worth $12.97. I would still be profitable factoring in the premium that I collected because my cost basis is $11.55. So you'll see it gives you some buffer as well. So it lowers your cost of goods sold. So unless this thing really tanks, I'm going to make money on this, okay? So options are basically a combination really of time and volatility. So in most cases, the farther out you go, the larger the premium will be. There's a lot to know about options, but when you start out, you don't have to know all of that if you're just focusing on one type of trade at a time. Selling puts is about as easy as you can get, but there is risk. Okay, so First Majestic, let's say that you firmly believe that this is going to $15 by the end of September, let's say. Okay, then you could go out and say, I want to select the $15 price. And you'll see that you collect a higher premium. You collect $2.81 potentially. Okay? So there's more reward, but there's more risk. Because if the price on September 18th is $15 or lower, then you take possession of shares. But maybe that's what you want. Particularly when a stock starts running away from you, this is a good way to get into a stock at a lower cost basis. Now, if you wanted to be extra conservative, you could say, well, I really don't want to take possession of this stock, but I want to collect a premium. Right now, having your cash in the bank, you're earning 0 to 2% on the bank and in the bank. Of course, it's perfectly safe. Trading options is never perfectly safe, but barring a complete collapse in the stock that you're looking at, which could happen, it's very, very possible. None of us knows the future. But barring that, so if you trade with you don't trade with all your money, but you carve out a trading allocation, whatever percentage you could afford to lose, worst case scenario, the advantage is that you could earn the equivalent of interest as premium. For example, if we go out to September and we say, okay, now I'm choosing the $11 strike price right here, okay? You'll see that the midpoint will say 60 cents. So if I risked 10 contracts, which would be 10 contracts times $1,100, that's $11,000. So you'd be risking $11,000 to collect $600. Because this is 60 cents, which is 59, I'm using 60. So 60 cents per share. So 10 contracts would be 1,000 shares. 1,000 shares times 60 cents is $600. The price is at $13. Could this go back to $11? Yes, it could. Will it? We're going to find out. But let's say that you've determined in your own mind that the risk is very low. So instead of going $15, which is much riskier, because now I'm betting that this stock is going to go up to $15 or higher by September 18th. The $11 strike price, I'm betting that the stock price will not drop below $11 to collect my premium. So your aversion to risk determines how much you want to collect. In this case, on the $15 strike price, I would be risking $15,000. Okay? I'd be tying up $15,000 because it's 10 contracts. If you just did one contract, then it would be $1,500 because each contract is 100 shares. So let's go the conservative route for now. So I'm going to close this, say sell to open. And I'm going to use 60 cents. Now, this is like entering any order in that I enter the premium that I want to collect. I could put $1 if I want. I want $1. Now, what it means is that this order would go into the system, and if the price of this stock drops, then this would rise from 59 cents up to 60 to 70 to 80 until it came to my dollar. Obviously, that's one strategy that some people use, is they enter orders so they don't have to think about it, and they'll be working one day and then they'll hear ping and they'll go to their account and they'll see that the order has been filled. Okay, so you'll see right here, this will collect a premium of $600. All right. So if you divide $600, and now $11,000 of your money is now allocated, is on hold until the 18th, or you close this contract. You can always close this contract earlier, or you can wait until its expiration, and it either expires worthless or it expires and you take possession of those shares. So we're going to assume for this argument that the price of First Majestic stays above $11 on the 18th. You hold it until then. It expires worthless. You do not, you basically get your $11,000 released, and you keep the $600. $600 premium divided by $11,000 is 5.45%. That's basically your return. And we will say that that's 50 days. So we'll just say 2 months for simplicity. 5.4%. If you could get that in the bank for 1 year, people would be happy. But we're getting that on this $11,000 in 2 months. So in essence, that works out to over 30% on an annualized return if we did this every 2 months. Okay? And that's the real benefit of selling puts, is you're collecting premium. And you're utilizing cash that would be sitting in an account collecting 0% interest. And you'll see that the way that I selected my strike price determines the premium I'm collecting, which is tied to the risk that we are put under. So you can actually choose very, very conservative. And most of these, Schwab, Fidelity, most of them have calculators in here, which will calculate the odds of you being exercised. So if you say, okay, it's never zero, but you can get the risk as low as possible. It just means maybe you're only collecting, 10 cents instead of 60 cents. But let's say you chose something for 10 cents, right? It sounds anemic, and it is. But if we're comparing it to the bank, so I'm collecting $100, right? Now, at what price? So if I go down to 8, see, there we go. So an $8 strike price, We'll go to 9. Okay, $9. So this would, the price on this stock would have to fall 50% for me to be exercised. So if I say, we'll just say 16 cents. So $160 I would collect on the 18th, assuming the price stays above $9. So $160 divided by, now my risk is $9 times 1,000 shares, so 9 grand. My return would be 1.8% for 2 months. Still much better than a bank. That's over 10% annualized return. And this is why you really should look into selling puts, selling put options. There's a lot more you can do with options. Again, I'm not saying that this is 100% risk-free, but even if you had $5,000 or $10,000 that you could put towards this, chances are, because if I had less money, I could just do one contract. Now, yeah, it's kind of ridiculous that I'd only be collecting $16, but I'm risking $900. It's the same percentage. It's still earning the same return. It's just not. And if I had more money, then I would increase my quantity. I mean, if you wanted to risk $20,000, right? So you can play around with these different numbers to find the return that you're looking for, the risk parameters you're looking for. And the better you know a company, the better you track a company, the more you know how successful a company will be, the safer this will be. Because if you can identify companies that are going to be appreciating, then it greatly reduces your risk. And even if there's a slight downturn in the market, you would be tickled pink to take possession of these shares, because if you take possession of these shares on a temporary turn down or downturn, then when the market rebounds, you can sell the shares. Now you can also sell calls and earn a premium on selling instead of just selling them, but we're not getting into that today. Silver and gold are probably going higher. Is that a guarantee? No, it's not a guarantee. There's no guarantee in life except we're going to die. Okay. Here's another company that I think is going to appreciate. Now this one, the other reason I like First Majestic is they have weekly contracts like you saw with Apple. So you could trade this every week. The downturn for Silvercrest Metals, which is symbol SILV, is they only have contracts every 30 days, once a month. So in this type of market where the volatility is so extreme, it's harder to hold something that long. But so for Silvercrest, you can see selling a $10 strike will collect roughly $1. So your cost basis would be $9. So your cost basis is lower than the current price. That's all good. So if you get exercised, you're already profitable. I think it's more likely that this company will be above $10 on August 21st, and you would collect this premium. So you would risk $1,000 to collect $100. That's a 10% return for 22 days. That's an excellent return. The next one, Equinox Gold. It's a gold company. These are all miners. This has gotten pushed down the last 2 days. It was up near 1250 2 days ago, and you'll see that it is now at 1150. So when the price of these things drops, that is when you really want to look at selling a put. When the price goes up, you don't really want to sell a put because your premiums drop. So you'll see now for $10, you're collecting 10 to 15 cents right in here, okay? $12.50, if it gets back to what the price was just 2 or 3 days ago, you would collect $1.30. Okay? So $1.30 divided by $12.50 strike price, that's a 10% return, over 10%, 10.4% for 22 days. That is more, that's like that's more than 125% return on investment annually. So if you wanted to say, okay, I have $5,000 I'm willing to put on this. Okay, well, $5,000 would be 4 contracts, right? Because 4 times $12.50 is 5,000. Now I can put in any premium I want. Doesn't mean it's going to be accepted, but this would be accepted. So I would collect on August 21st, if the price of this stock was $12.51 or higher, then I would collect $520. Again, that's a very good one. So what I will do is periodically, when I see opportunities like this, I will make a video like this. And then we will find out in a couple weeks how good my record is. So if it was me, I would look at, for First Majestic, I would look at doing either August 21st or September 18th. Now, they have weekly contracts, so you can go plus or minus a week. You will see the farther I go out, the premium does not increase as rapidly. Although if I go out to October, you'll see for that same price, see it only went from 280 to 315. So the downside of that is you're tying up your money for another month and you're only collecting an extra 30 cents. Not really ideal. But if you were convinced this company is going to the moon, well, maybe you'd be happy just earning those 30 cents because let's say in September, the price of this company is now $20. I'm not even going to be able to get a $15 strike price and earn this type of premium. I'll probably be collecting a dime if the stock price was at 20. So that's why you would lock in a longer date. There are other reasons to sell puts. A lot of people use them as hedges when they are on the other side of the trade. So it protects their position, and that's really what a lot of people use options for. What I'm advocating people do is they look at this as collecting premium. And depending how risk adverse you are, you can be very, very conservative, and it would take an extremely strong move in the market for you to get exercised. Now, the farther out you go in time, okay, if I'm going out to September, that's 2 months from now. Anything could happen. We could be dead in 2 months. So the market could be zero in 2 months. So that is tied directly to risk. And that's why the premiums go higher for out there. So these are all things you have to factor. If you wanted to do a contract that was closer date, 8/7, a week away, okay, well, will this stock be up to $15? It could be. It could be. And for those people willing to make that gamble, let's say that I was convinced that this company was going to be $20 by the end of the year, then there's nothing wrong with me making that decision, going to $15, because I'm collecting the premium, and my cost basis is also less than $13. It would be a $15 strike price minus the $2.15. So in essence, whether I bought shares, it might be an excellent decision. Okay? So if you have any stocks that you would like me to look at, that you're interested in, that you follow, please pass them along. I'm always looking for good ideas, and it's something that we can evaluate. And again, I'm just another guy, just offering my 2 cents. And if I'm right a majority of the time, I'm happy. With trading, most of the time, you just want to avoid losses. You want to avoid big losses. And if you can avoid losses and let your winners run, then you're going to do okay in the markets. I am a firm believer in using this method to scalp. And as you can see in the examples I used, you can earn a lot more money doing this than you can leaving your money in a bank. But you do not want to use money that you want 100% safe. Now, is a bank 100% safe? No, but we're going to say for our purposes that we're assuming it's 100% safe compared to this. If you've never traded options before, I strongly recommend that you learn. Do not be afraid. There's an excellent book written by Lee Lowell called Get Rich with Options, 4 Winning Strategies Straight from the Exchange Floor. This man, his strategies in there, including the one I just reviewed, it's a gold mine. If utilized properly, you will make a lot of money. And I will say guaranteed with a caveat. And the caveat is make good decisions. There we go. Hello again. If you have questions, leave them in the comments. So let's just leave this as entertainment, education, and me and Dan are trying to produce content that will hopefully help people. This 2020 has been a very difficult year for most people. And unfortunately, I don't think that the pain has been felt by a lot of the people who are going to feel this pain. And so this is an opportunity to create an additional revenue stream. And it's like anything. It's a comfort level. It's learning the ins and outs of something. So don't let fear dictate your life. Grab the bull by the horns and learn this skill. It may only be a few $1,000s a month or a few $1,000s a year. I've helped people with this who are making a lot of money, relatively speaking. You define what's a lot of money, and I'll let you know if they're making a lot of money. Okay, so let's see if these trades work out. Hopefully over time, if I'm doing this, I'll be able to prove that what I'm talking about is legitimate. And the only way I can do that is to say, okay, today is this date. These are the dates that I'm selecting you choose, the strikes that you choose, and we'll see how they work out. Okay, so to review, First Majestic, Equinox Gold, and what was the other one? Oh, Silvercrest. Silvercrest, $10 strike, August 21st. Equinox, August 21st, $12.50 strike. And First Majestic, me personally, I'd go with a $13 or a $15 strike. Say $13 for August and a $15 strike for September. So those are the 4 trades that we'll put on paper trade, and we'll see how they play out over the next month or 2. Okay? I hope everybody's well, and hope you have a great day.